Hi guys, Jono here again from Capital Edge. Today we're going to have a look at Lender's Mortgage Insurance, or LMI, which to a lot of people is a dirty word. Now this is a bit of a follow-on from my last video about LVR, or loan to value ratio. Now LMI, I'll just explain how that works. Lender's Mortgage Insurance is actually an insurance for the bank to cover a debt if the person cannot repay it. So 20% is the normal deposit on an investment property or buying your own home, and you don't need any lender's mortgage insurance. The bank is basically saying if we have a 20% deposit, they've got enough of a buffer that they don't need to have much risk in you not being able to pay the debt should they have to sell it from under you. Anything less than that requires lender's mortgage insurance, or LMI. Now, how is it charged? It's a sliding scale, which you'll see from here, that starts at 80%, and the charges for LMI aren't too severe until you get to about 90%, and then it skyrockets up to 100% loan. Now, with your loans, you may think 100% loan, that's impossible, but banks from time to time, and probably as long ago as 4 or 5 years, were doing 100% loans. At the moment, you can probably get an investment property with about a 90% loan and your own principal place of residence with a 95% loan. And in both of these examples, you're going to be required to pay lender's mortgage insurance. Now, as I said, at 90%, the fee is a lot less than, say, at 95%. It also changes depending on how much the purchase price is. So obviously, if you're buying $1 million home with a small deposit, your lender's mortgage insurance is going to be a lot higher than if you're paying $500,000 on an investment property with a 10% deposit. Now, one thing that people say is lender's mortgage insurance, they don't like it because it's a cost that they're paying and they see no real benefit of it. I've flipped this completely in my wealth creation, and I really quite like lender's mortgage insurance because what it does is it lets me use less of my money or less of my equity against my own home and get into my second, third, fourth property. Now, I'll explain this across here. In this example, if we had $250,000 cash or available equity in your own home, obviously it's more likely we've got $250,000 equity than cash, but everyone is in a different circumstance. Option 1 to avoid any lender's mortgage insurance, or LMI, is a purchase of $500,000. We're going to put our 20% deposit in to avoid LMI, which is $100,000. Our costs for stamp duty, interest during construction, and legals is $20,000. We've got to stump up $120,000 of either our cash or our equity to make this deal happen. Now, option 2, we pay LMI. Now, at the moment, for lending against investment properties, you need about a minimum of a 10% deposit. So your approximate LMI might be about $7,000. So it's cost us $7,000 for this experience. However, again, a purchase price of $500,000, we now only need a deposit of 10%, which is $50,000. The costs remain the same at $20,000. So in total, we've had to put in $70,000 to get our investment property instead of over here $120,000. So what this means is we've kept $50,000 of equity or cash in our pocket, and this $7,000 LMI fee actually gets put on top of the loan. So you don't really notice it as much over a 30-year loan term, but what this does is, hypothetically, you're only using $70,000 instead of $120,000, so we're a lot closer to being able to duplicate or get our next property. I've done 6 investment purchases, and throughout all of those, I've always used and paid LMI because it leaves more money in my pocket and leaves me more resources to do the next property. Anyway, if you want to discuss this further or explore it more, please give our 1300 number a call, or alternatively, get onto the website, download our free book, have a look at the information there, and I'd love to see you to discuss this further and see how this can help you create wealth in the future. Cheers.